What's up guys, my name is Nick and welcome to my channel. In this video I'm breaking down the long call debit, or as it's sometimes referred to, the long bull call spread. I'll be taking a look at how a vertical option spread like this can be used not only to reduce your cost and potential risk in your option trades, but also improve your POP or probability of profit. Before we dive into my laptop and I share my screen with you, do me a huge, very low cost favor and smash the like button. If you enjoy this video, be sure to subscribe to the channel and turn on notifications. I upload new option-ready content every week. With that said, let's dive straight in and I'll see you on the other side. Cheers. When traders first look at options and options trading, it's typically from a long outright perspective. Most of us, for example, find it easy to understand the simple concepts of buying calls when we are bullish on a stock and expect its price to rally higher. Buying puts when we were bearish and expecting the stock's price to fall. An added attraction of options, of course, and one that traders seem to work out even more quickly, is that of leverage. It is much, much cheaper to control stock through an option contract than it is to buy the underlying shares. Let's take a look at a call options chain and build a bullish position on ABC stock. ABC is currently trading at $100 a share. On the left-hand side of the screen here, we can see the prices of call options struck every $5 from 90 all the way up to 110 with their associated prices. So if we were to buy a single 95 strike call option, we need to pay $7.50 a contract. Since this contract controls 100 shares of stock, the total cost of this option is $750. Note that paying this premium gives us the right to buy 100 shares of ABC at $95 a share by the expiration date, should we wish to do so. This bullish position, we are hoping that the stock rallies of course, is significantly cheaper than the $10,000 it would cost to buy 100 shares of stock at the current market. Okay Nick, so far so good. What's the issue? I don't see a problem here. This chart shows the price of ABC as it trades between now and the option expiration date. We begin with the stock trading at $100 a share. Notice the stock trades up and down and finishes at expiration at around $102 per share. That's great since we had a bullish view on the price of the stock, but there's two problems here. First, it's important to note that an option is a wasting asset. Anytime prior to expiration, there's a component in an option's price or premium known as the time or extrinsic value, and this decays over the lifetime of the option. All else being equal then, a long option will be worth less and less with each day that passes. Additionally, in order to make money, the stock not only has to go up, but has to go up a lot just to break even. In our example then, since we paid $7.50 for the call option, which is struck at $95 a share, we need the stock to close above $102.50 before this trade starts to realize a profit. The more volatile a stock, the potentially further the price might move of course, but then we find that option prices are typically more expensive as a result. Let's look at a way where we can still have a bullish directional assumption on ABC, but can completely eliminate this time or theta decay. Okay, so again with ABC trading at $100 a share, we can buy the 95 strike call option for $7.50. This time though, let's also sell an out of the money 105 strike call for $2.50. This additional leg in the trade results in a credit of $250 from the sale of the higher strike option and an overall decrease in the net cost of the position to $500. We are now long what is referred to as a 95-105 bull call debit spread at $5 a contract. Let's take four possible scenarios for the price of ABC stock between now and the expiration date and see how the returns of the two positions compare. In scenario 1, ABC trades higher and rallies to $105 a share in price. Let's see how the long call debit spread, which recall is long the 95 and short the 105 strike call, performs under this first scenario. Since the stock price is right on the short 105 call strike, this call option is worth $0. As we sold this option for $2.50, we get to pocket this premium for a $250 profit. The long 95 call is now worth $10, and so since we paid $7.50 for it, we are also up $250 on this leg of the spread. The total net profit on the trade then is the sum of the two, or $500. Since the risk on the trade is the net premium paid, or $500, our percentage return on the trade is 100%. The outright long option returns $250. We did, however, risk the full premium, or $750, on the trade, which reduces the return on capital to 33 1/3%. So both positions make money, but in scenario 1 at least, the spread has a better performance. Let's take a look at scenario 2. Here we see a situation where the stock is unchanged over the lifetime of the trade. Again, breaking down the profit and loss for each leg of the spread, since the 105 call is out of the money, it expires worthless and we collect all of the $250 in premium. The long 95 call, however, is now only worth $5. Since we paid $750 for the option, we lose $250. The total net return then is $0. However, the long outright call option did not fare as well. The $250 loss on the trade represents a negative 33 1/3 return on the capital at risk. Okay, how about a situation where our outlook for the stock is totally wrong and the stock price falls? In scenario 3 then, the stock price drops down to $90 per share. This will clearly result in losses for both positions, which are of course bullish. The spread loses $500. The long call expires worthless, and so we lose the full $750 we paid for the call option there, but the sale of the 105 call offsets $250 worth of those losses. While both positions lose 100% of their value, since the debit spread has a lower net cost, that loss is reduced by $250. In all 3 scenarios, the spread has outperformed better, but let's see in what circumstances the long outright option does better. In scenario 4 then, the stock price jumps sharply higher to $110 per share. Both bullish positions do well, of course, but let's see exactly how well. The short 105 call is now $5 in the money and so is worth $5. We sold this for $2.50 and so we lose $250 on the sale of this option. The 95 call though is $15 in the money and so returns a very nice profit of $750. The net profit, which is incidentally the most the spread can make, is $500. The return on the long option is not capped in this way and is undefined. The call option will continue to make money as long as the stock continues to rise. Specifically though, at $110 a share, the long call returns a $750 profit, outperforming the spread for the first time in our various scenarios. While the potentially unlimited returns of the outright call option look appealing, it's important to understand that if this spread position was structured with a short call with a 25 delta, for example, that the spread should be expected to outperform 3 out of every 4 times you ran the position, or approximately 75% of the time. To finish up, let's take a look at how we go about calculating the maximum profit and loss for a debit spread, as well as the trade's break-even prices. The maximum profit is calculated by taking the difference between the 2 strikes. In our example, $10, that's the 105 minus the 95, and then subtracting the net premium paid for the debit spread, or $5. Our maximum profit then is that difference of $5, or $500 per contract. The maximum loss is the net premium paid for the spread. In our example, we paid $500, and so this represents our maximum risk, and this is also the capital your broker will require in your account to cover the trade. The break-even point occurs when the stock has rallied sufficiently above the long option strike to cover the premium paid for the spread. Since we bought the 95 strike call and paid a net debit for the spread of $5, our break-even is $100 a share. Note in this case, because of the way the trade is structured, the risk-reward payoff is 1-to-1. We are risking $500 to potentially make $500, and the trade has approximately a 50% chance of success. It's important to note that risk-reward and probability of profit are inextricably linked. It is possible, for example, to move both of the call strikes in the spread higher so that the long strike is now also out of the money and above the current stock price. As a result, the net debit paid will be lower, so the risk to reward ratio will be higher. However, the probability that the trade is profitable will now fall well below 50%, as the stock will need to move much higher in order to reach this new spread's break-even price. Guys, if you made it this far, you made it to the end, and your support is very, very much appreciated. Again, if you enjoyed the video, do me a huge favor. You can subscribe to the channel down here, or if you prefer, you can click over here to watch more option-related content on this channel. Until the next one, guys, take it easy. Cheers.